Imagine waking up one morning and seeing gold prices suddenly jump across global markets. Investors rush to buy. Headlines start flashing. And surprisingly, the reason behind the move is not a war, not a recession warning, but a single political decision coming from Washington. When policy shifts inside the White House, the ripple effect can travel across currencies, stocks, and one asset that investors trust more than almost anything else: gold. The relationship between political power and gold prices is something many people overlook. But when the policies of leaders like Donald Trump begin to shape trade, interest rates, and global confidence, the gold market often reacts in ways that surprise even experienced investors. Today, we're going to break down how those policies can influence gold prices, why investors around the world watch them closely, and what it could mean for the future of the global economy. If you want to understand the deeper forces that move gold beyond simple supply and demand, stay with us. And before we go deeper, if you enjoy content that explains the real forces behind the gold market in a simple and clear way, make sure you like this video and subscribe to the channel. On the Gold Report, we break down global events, economic shifts, and policy decisions that influence gold prices, so you can stay informed about what's really happening behind the scenes. Now, let's begin with something important to understand. Gold is not just another commodity like oil or wheat. Gold behaves differently because it is seen as a safe haven asset. Whenever uncertainty rises, whether it is economic instability, political tension, or financial crisis, investors often move their money into gold. That's because gold has historically maintained value even when currencies weaken or stock markets fall. So when government policies begin to create uncertainty or major economic change, gold often becomes a key indicator of investor sentiment. During the presidency of Donald Trump, several major policy decisions affected global markets. These included trade policies, tax reforms, pressure on the central bank, and shifts in international relations. Each of these elements has a direct or indirect connection to gold prices. One of the biggest factors was trade policy. The administration introduced aggressive trade tariffs, especially targeting imports from China. These tariffs created uncertainty in global trade markets. When businesses and investors become uncertain about the future of international trade, they often look for stability. And historically, that stability is often found in gold. During periods when trade tensions escalated between the United States and China, global markets became volatile. Stock markets sometimes dropped sharply, and during many of those moments, gold prices started rising. Another factor was the relationship between the White House and the Central Bank of the United States, the Federal Reserve. The Federal Reserve controls interest rates, and interest rates have a powerful effect on gold prices. When interest rates rise, holding gold becomes slightly less attractive because gold does not pay interest. But when rates stay low, gold often becomes more appealing because investors are not losing potential interest income by holding it. During the Trump presidency, there were several moments when he publicly criticized the Federal Reserve for raising interest rates. These statements created tension between political leadership and monetary policy. Investors began questioning whether interest rates would remain stable or change direction. Whenever uncertainty surrounds central bank policy, gold often benefits because investors seek protection from unpredictable monetary conditions. At the same time, the administration introduced major tax cuts within the United States. These tax reforms boosted corporate profits and initially helped stock markets rise. When stock markets perform strongly, gold sometimes loses momentum because investors prefer higher return assets. However, large tax cuts can also increase government debt over time. Rising debt levels sometimes weaken long-term confidence in a currency, and when confidence in currency weakens, gold becomes more attractive as a store of value. Another key policy area involved the strength of the US dollar. The dollar plays a major role in the gold market because gold is globally priced in dollars. When the dollar becomes stronger, gold often becomes more expensive for international buyers, which can reduce demand. But when the dollar weakens, gold often rises because it becomes cheaper for investors using other currencies. Throughout several points during the Trump presidency, discussions around trade deficits, economic competitiveness, and monetary policy created fluctuations in the value of the US dollar. Each movement in the dollar had an immediate impact on global gold markets. There was also a geopolitical dimension. Changes in international relations and negotiations with various countries often increased global uncertainty. When political uncertainty grows, especially involving major economic powers, investors frequently move toward safer assets. This is why gold prices often rise during periods of diplomatic tension or geopolitical conflict. But what makes the connection between policy and gold even more interesting is psychology. Markets are not driven purely by numbers. They are driven by expectations. If investors believe that a policy could lead to inflation, currency weakness, or economic instability in the future, they often begin buying gold before those events actually happen. Inflation is particularly important here. If government spending increases rapidly, or if economic stimulus expands the money supply, inflation expectations can rise. Gold has historically been viewed as a hedge against inflation. That means when people believe inflation will increase, demand for gold often rises as well. Another element that affected markets during that era was economic stimulus and fiscal policy. Large government spending programs can stimulate economic growth in the short term, but they can also increase national debt. Some investors worry that long-term debt expansion can weaken currency stability. In those situations, gold again becomes attractive because it exists outside the traditional currency system. What's fascinating is that gold often reacts not only to what governments actually do, but also to what they might do next. Market expectations play a massive role. When investors speculate about future policies, gold prices sometimes move even before those policies are implemented. Let's consider another angle that many investors overlook. Political leadership can influence market confidence. Confidence is one of the most powerful forces in financial markets. If investors feel confident about economic stability, they often invest in growth assets like stocks and businesses. But if confidence weakens, even slightly, capital begins moving toward defensive assets like gold. During times when political debates, economic negotiations, or international disputes dominate headlines, gold tends to receive increased attention from institutional investors, hedge funds, and central banks. Central banks themselves are major buyers of gold. Around the world, many central banks hold gold as part of their reserves. These reserves help stabilize national financial systems during times of crisis. If geopolitical tensions increase or if economic uncertainty rises globally, central banks sometimes increase their gold holdings. This institutional demand can push gold prices even higher. Another aspect worth discussing is the role of financial markets and media. When political decisions attract strong media coverage, investor reactions can become amplified. Headlines about tariffs, economic negotiations, or currency policies can create rapid changes in investor sentiment. And because gold is traded globally across futures markets, ETFs, and physical markets, price reactions can happen almost instantly. All of these elements together show why gold is deeply connected to political and economic decisions. Policies related to trade, interest rates, taxation, currency strength, and government spending can all indirectly influence gold demand. This is exactly why analysts and investors around the world carefully watch government announcements and economic policies. Even small policy signals can send strong messages to financial markets. Here on the Gold Report, we focus on explaining these connections so viewers can better understand why gold prices move the way they do. Instead of just looking at price charts, we try to explore the deeper forces shaping the global gold market. Now imagine the future. Political leadership will continue to change. Economic policies will continue to evolve. Trade negotiations, central bank decisions, and global economic competition will keep influencing markets. And through all of these changes, gold will likely continue playing its historical role as a financial safety net. Investors who understand these relationships often make more informed decisions. Instead of reacting emotionally to price swings, they observe the broader economic environment and evaluate how policies might shape future market conditions. The connection between politics and gold is not always simple or immediate, but over time the patterns become clear. Policy decisions can influence inflation expectations, currency strength, economic growth, and investor confidence. And all of these factors feed directly into gold demand. As global economies become more interconnected, these relationships may become even stronger. A policy decision made in Washington can influence markets in Asia, Europe, and beyond within minutes. And when global investors start looking for stability during uncertain times, gold often becomes one of the first assets they turn to. Understanding this dynamic gives investors a deeper perspective on market movements. Instead of viewing gold purely as a commodity, they begin seeing it as a reflection of economic confidence, geopolitical stability, and monetary policy. That is why discussions around leadership, economic strategies, and global relations often intersect with the gold market. And now we'd love to hear your perspective. Do you think political policies have a major impact on gold prices? Or do you believe the gold market is driven more by global economic forces? Share your thoughts in the comments below because discussions like these help everyone better understand the bigger picture. If you found this breakdown helpful, make sure you share this video with someone who follows financial markets or invests in gold. Conversations about economics and global policy become much more valuable when more people understand the forces shaping the market. And of course, if you want more deep insights into gold, global economics, and the hidden factors influencing market trends, don't forget to subscribe to the Gold Report. We'll keep bringing you clear explanations and powerful insights so you can stay ahead of the trends shaping the future of the gold market.